You want to see a rocket ship? Look at SoFi shares. Now they're up 19.5%.
Shares popping double digits on those strong results, almost up 23% right now. CEO Anthony Noto joins us. Anthony, thanks for being here. Big quarter for you all. Profitable one, record revenue across the three businesses. Solid profitable outlook as well. What are some of the key drivers that you think led to these results?
What were the main contributing factors to you guys hitting profitability on a net income basis? And how confident can the street be that you continue on this arc of increasing profitability?
I think people are surprised. Clearly, there's a lot going right at SoFi right now, even when they decide themselves to pull back on some of the loan originations.
SoFi just reported Q4 numbers that surpassed all analyst expectations for the first time ever, becoming a profitable company and guiding sustainably profitable every quarter going forward. And on top of all of this, on the earnings call, Anthony Noto highlighted some massive growth targets for the company going as far as 2026, far beyond what any analyst is projecting for the company. And I think that he dropped a lot of hints with regards to the product roadmap, with regards to the valuation, and with regards to where SoFi is really going. This video will be a full breakdown of Q4 earnings. Let's jump right into it.
You're watching the Fundamentals of Investing podcast breakdown of SoFi's Q4 earnings call. I'm Roy, and I endorse this message.
Okay, as with any other earnings breakdown video that I've done in the past, I will split this video up into several sections, talking about financial services, lending, tech platform respectively, before moving on to guidance, financials, and analyst price target changes. I cover SoFi extensively on my channel, and if you want to follow along with the company news, rumors, analyst price target changes, and much more, subscribe now and follow along. On the top line, SoFi reported $594 million in adjusted net revenue, up 34% year over year. They reported $181 million in adjusted EBITDA for Q4, up 159% year over year, with a massive 30% EBITDA margin for Q4, which is absolutely insane, and we're going to talk about it. The bottom line came in at 2 cents EPS, the first ever quarter that the company has reported profitably. This was higher than analyst expectations. Revenue beat expectations by $22 million, and the bottom line beat expectations because analysts were expecting SoFi to come in flat, 0.0, and SoFi came in at 2 cents EPS. And Q4 also marked the company beating their Q3 guidance, which they had raised 3 times over the course of 2023, and the company also provided 2024 guidance and beyond. From a members perspective, members were up 44% year over year to 7.5 million for the total in 2023, a 585,000 new member addition in Q4. Similarly, products were up 41% year over year to 11.1 million total products, a 695,000 product addition. Now, let's break down the members by segment, starting first at the ratio of financial services products to lending products. SoFi is predominantly comprised of financial services products. If you break out their 11.1 million products, you'll see 85% is in financial services and only 15% of their total products is in lending. Or said differently, if you look at the ratio, there's a 5.7x difference between those two segments. And this number is growing every single year. And the reason for this is because financial services are just overall much easier to onboard. They have a lower barrier to entry. For example, if I were to open a SoFi Invest account or a checking account with SoFi, this is much easier for me to do than if I were to start a mortgage with SoFi or a student loan with SoFi, right? They're just overall lower commitment products. And as a result of that, more people on board to those products because it's easier. And we see that not only is financial services 85% of their total products, by far and away their largest segment in terms of products, but actually financial services is also the fastest growing segment as well. In Q4, we saw financial services grow by 45%. And in fact, if you take a look at the disclaimer towards the bottom of the screen here, this growth was actually closer to 50%, except that the company had to exclude all of the now closed digital asset business products, right? If you remember, we talked about this in a previous video towards the end of 2023. SoFi exited completely out of the crypto space, and as a result of that, these products were not counted in the Q4 growth numbers, which brought the average down from 50% year over year to 45% year over year for financial services products. By contrast, as I mentioned before, due to the higher barriers to entry for lending products, and also the high FICO score requirements, lending products are growing at a steady pace of 24% year over year to 1.6 million total lending products to end off 2023. Okay, so now that we know how the products breaks out by segment, let's dive one layer deeper into each of these segments and the business lines comprising them, starting off with lending. SoFi's lending segment, for example, breaks out into 3 respective business lines: personal loans, student loans, and home loans. Now, in terms of the product originations, we already took a look at the chart, which was a blended 24% growth in products. The majority of this increase, however, was due to personal loans, which grew 33% year over year to 1.1 million products. Home loans, by contrast, which is the smallest business line in the lending segment, grew 14% year over year. However, if you look at the absolute numbers, this is a pretty marginal increase because of how small home loans is. Now, in terms of student loans, by contrast, the total products grew by 9% year over year. And student loans have been hurt for the majority of 2023 until the moratorium ended just recently, a couple months ago. Moving over to originations now, by contrast, we can see a different story here. Personal loan originations came in at 3.2 billion for Q4 2023, a 31% increase. Personal loan originations, however, were down 17% quarter over quarter, but they were up 41% in the full year basis when compared with 2022. Student loans came in at 790 million for originations at the end of Q4, up 95% year over year. And the surprising part here was that student loans actually declined 14% quarter over quarter. The majority of us on SoFi Weekly, in our predictions episode, estimated that student loans would surpass 1 billion in originations as opposed to being down quarter over quarter. So this number was definitely softer than what I personally was expecting and what I know many were expecting. Because back in 2020, for example, when the moratorium first hit, SoFi was predominantly a student loan company, and this segment was doing 2 billion. And now that the moratorium finished in the fall, it's slowly ramping up at a slower run rate than we initially expected. And actually, as I'm thinking about it, I think Q4 was actually the first quarter, full quarter, where we had student loans back, because I think in Q3, they weren't actually fully restarted by that time. And so one thing to keep in mind here with regards to student loans is still that the Biden administration is still heavily incentivizing borrowers to defer their payment out with a 12-month grace period, which essentially takes off a lot of the negative repercussions for missing payments for student loans. And that's obviously going to affect SoFi as with any other student loan provider. So the long story short there with regards to student loans is that it's still ramping up, but it's doing so at a slower clip than what we had initially expected. Finally, from an originations perspective, moving over to the third lending segment, home loans increased 193% year over year in Q4 and also declined 13% quarter over quarter. So all 3 of the lending segments actually saw a decline quarter over quarter. With regards to the home loans, one of the factors to consider is, of course, the acquisition of Wyndham Capital, which closed earlier in 2023 and which management highlighted was already positively contributing to the lending segment as early as Q2. However, 2023 was not a favorable environment for home loans because the interest rates were so high. And as a result, home loans as a business segment were negatively impacted by this. I mean, just think for yourself, you wouldn't want to buy a home when interest rates are so high. The flip side of this is as we go into 2024, when rates are expected to fall, home loans is expected to pick up as a result. But now, before I move on to some of the financial results for the lending segment, I found it interesting to highlight the weighted average income and the FICO scores for student loans and personal loans. On the earnings call, management highlighted that personal loan borrowers' weighted average income was $171,000 with a weighted average FICO score of 744, and student loan borrowers were $154,000 average income with a higher FICO score, 781. These are near perfect borrowers. The average borrower for SoFi student loans and personal loans is near perfect on a FICO perspective, and they're earning well above $100,000 on average. Taking a look now at some of the financial results for the lending segment, we can see the GAAP net revenue was $353 million, up 8% year over year for Q4. And on a full year basis, GAAP net revenue came in at $1.37 billion, up 20% year over year. Now, every time I talk about the financials for SoFi, I talk about the difference between net interest income and non-interest income. Net interest income at a high level is simply the difference between the revenue that the bank's interest-bearing assets generates and the expenses incurred. Non-interest income is primarily derived from fees, such as origination fees in mortgages, penalties on late payments, and overdraft fees. So the net interest income for SoFi's lending segment in Q4 increased by $79 million to close off the quarter at $262 million, a 43% year-over-year increase for Q4. Management highlighted that this was due to higher loan balances and net interest margin expansion. On a full year basis, net interest income is up 81% to $960 million. By contrast, if we look at non-interest income, this has been declining. It's down 37% in Q4 and 33% on a full year basis. However, if you look at the aggregate numbers, the decline in non-interest income is more than offset by the increase in net interest income. And if we go one level deeper and subtract the directly attributable expenses, this gives us the contribution profit for the lending segment, right? We take the total revenue, we subtract the expenses, and we get the profit. For Q4, SoFi reported $226 million profit for the lending segment, an 8% year-over-year increase. And for the full year basis, the company reported $823 million profit for lending, a 24% year-over-year increase. Now, SoFi did talk about loan sales on the call. They grew their capital ratios to 15.3% from 14.5% quarter over quarter, and they closed over $1 billion in loan sales. They did mention on the call that this is comprised of personal loans and home loans totaling $1.2 billion, and approximately $875 million in student loan principal and $350 million of home loan principal. But I don't want to go into a lot of the specifics. The important point there is that SoFi did sell loans and they are restarting their loan sales at a much higher level. I believe in Q3, it was only a fraction of the loans that they sold in Q4. And from what management is telling us, the loan sales are going to continue in 2024, which is obviously a positive sign. Let's move on now to the financial services segment, first by breaking down the products. A moment ago, we talked about the total financial services products being around 9.5 million. Now let's go into the individual lines of business that make up SoFi's financial services segment. The segments are as follows: SoFi Money, which includes SoFi checking and savings account held at SoFi Bank; SoFi Invest, which is their brokerage side; credit card; referred loans, so essentially loans that they're farming out to third-party services and collecting a referral bonus, essentially; Relay, which allows users to see their spending, savings, credit score, and overall do a health check on their financial well-being. This is similar to Mint, which was recently discontinued by Intuit and is one of SoFi's most popular products, actually their fastest growing product as of Q4. And finally, SoFi at Work, which is their B2B segment, where SoFi partners with employers to offer employee benefits. This is similar to the student loan and contributions and refinancing that we've been hearing so much about recently with regards to the Kimley Horn partnership in December and the Chipotle partnership just last week. In terms of the total product growth for financial services, we see a blended total growth of financial services products of 45% year over year. In addition, we see double-digit growth for all of the financial services business lines, with Relay being the fastest growing line at 74% year over year to 3.3 million total Relay products, and SoFi Money being their largest financial services business line by total products at 3.37 million total products. Referred loans and SoFi at Work are the smallest business lines from a financial services perspective. Management also highlighted in the earnings call that SoFi Money does still have an offering of 4.6% APY with no minimum balance requirements and a $2 million FDIC insurance. Sticking here for a second on the money segment, total deposits grew 19% during the fourth quarter to 18.6 billion at the end of 2023, and a whopping 90% plus of SoFi Money deposits came from direct deposit members, and more than 50% of newly funded SoFi Money accounts are setting up direct deposit by day 30 as of Q4. And in terms of our predictions on the SoFi Weekly side, I think the deposit numbers were the closest across the board, with a 2.9 billion new deposits that SoFi actually ended up adding. Now, let's move on to the financial services operations. This too is split between net interest and non-interest income, similarly to the lending segment. The financial services segment for Q4 recorded a net revenue increase of 115% to 139 million from 64.8 million. And one of the most exciting things for me that I saw here was that the net income of financial services increased by a whopping 115%, yet the expenses only increased by 5%. This is absolutely terrific management of expenses, and it shows the growth of these segments. If you look at many of these segments and many of these business lines, you'll see a similar trend where the revenue is increasing at a much higher clip than the expenses are increasing, and thereby increasing the margins overall. For full year 2023, total net revenue for financial services was $436 million versus only $167 million for the full year 2022. This is a 160% increase, and a similar story here with regards to the directly attributable expenses, which only rise 19% during this full year period. Financial services net interest income grew 139% year over year in Q4 to $109 million, and non-interest income also grew 56%. And more impressively, on a full year basis, net interest income more than tripled to $334 million from $92 million, a 262% increase. Non-interest income on the full year basis also grew 35% to $101 million. So basically, financial services is growing terrifically while keeping all of their expenses in check. This is exactly what you want to see, especially as management on the earnings call highlighted that they're still in the aggressive expansion of the credit card business, and that business line in financial services is still losing money. So a lot of this we can expect to be, SoFi Money carrying the load of this profit, essentially. Now, after we deduct these expenses, we can see a contribution profit of $25 million for financial services for Q4. Remember that in Q3, SoFi barely squeaked through with a $3 million contribution profit, and the next quarter, this has ballooned to $25 million. And when you look at a full year basis for 2023, you can see that they're basically flat from being down $200 million in 2022. And this is one of the biggest contributing factors for the company becoming profitable, because as of Q3, all three business segments became profitable, and as of Q4, the entire company became profitable. And just by looking at these trends, if we have triple digits in revenue growth and we have single digit in expense growth, we can expect a very, very healthy 2024 for SoFi for the financial services segment. Now let's turn to the third and final segment for SoFi's business, the technology platform. The tech platform total accounts grew by 11% year over year to 145 million at the end of Q4 from 130 million at the end of Q4 2022. Management highlighted that there is a robust pipeline of ongoing discussions with potential partners with large existing customer bases across both the US and Latin America, spanning both the financial services and the non-financial services segments. Although when an analyst asked them to name drop some of these clients on the earnings call, they refused to do so. In terms of the segment financials for the tech platform, the net revenue came in at $96.9 million for Q4, up 13%, and $352 million for the full year 2023 at 12% growth. And one interesting thing to note here is that the directly attributable expenses actually fell year over year on a quarterly basis, 4%, and only increased 8% on a yearly basis. This led to a large increase in contribution profit, which came in at $30 million for Q4, up from $16.8 million in Q4 2022, an 81% increase. So similar trend here, right? The growth in the top line is higher than the growth in expenses. In this case, expenses on a quarterly basis is actually even falling, and on a yearly basis is only increasing by single digits. So just an absolutely tremendous management of expenses. However, for the tech platform, all we want to see really is an acceleration in that growth in both accounts and in the margins. On a full year basis, the tech platform had about $95 million in profit, a 24% year over year increase. Management highlighted that in Q4, this growth was driven by continued strong organic growth of existing partners, new product adoption, and notable contributions from increasingly diversified clients, which have launched within the last 6 months. As noted previously, we continue to make significant strides in our strategy of leveraging our unique product suite to pursue diversified growth and larger, more durable opportunities. Now, let's talk about some of the financials, diving a little bit deeper into the results before moving on to guidance. Net revenue, as I mentioned, came in at $594 million, which was up 34% year over year. And more impressively than this was the bottom line growth, right? We knew that this quarter, SoFi is going to be making all the possible adjustments to report that profitability to basically ensure that that happens. And I mentioned in my prediction video that this just didn't add up for Q3. It didn't make sense, right? Because SoFi increased their guidance in Q3, and in order to hit those numbers, they would need a roughly 26% EBITDA margin for Q4. Obviously, this seemed like a tall order because the previous quarters had come in at 16%, 16%, and 18%, and all of a sudden we're expecting a jump to 26%. Well, in fact, SoFi delivered on this beautifully and actually beat this expectation by coming in at a whopping 30% EBITDA margin for Q4. totally smashing my expectations and pretty much the expectations of every analyst out there. And in fact, I think this was a singular chart that made everyone more excited about the prospect of SoFi as a sustainable, profitable company going forward. Especially because if we look here at their guidance for 2023, not only did SoFi raise this guidance 3 times during the year, they also in fact even beat to the higher end of their adjusted guidance, reporting 2.07 billion in the full year revenue and 432 million in adjusted EBITDA, representing a $36 million beat of the high end of the range and a 21% blended EBITDA margin for the full year 2019, even though they were expecting a 19% margin in their Q3 guidance. So we see this consistent trend of even though they raise expectations consistently, they still come in above those expectations. Absolutely spectacular results. And I made a post on X posting the annualized EBITDA numbers on a yearly basis, where you can see this beautiful trend line over the past 4 years and the corresponding margins climbing from the negatives all the way to culminate with the 21% that they reported in 2023 on a yearly basis. And right beside this chart, you can see this hockey stick-like growth of adjusted annual revenue and then the corresponding double-digit year-over-year growth percentages. In addition to the full year 2024 guidance, SoFi also issued guidance for Q1 of 2024, expecting to deliver 550 to 560 million in adjusted net revenue and 110 to 120 million in adjusted EBITDA and a 10 to 20 million GAAP net income. But of course, if we've learned anything from SoFi over the past 2 years, is that they will report Q1 results likely slightly higher than this range, and they will also raise guidance for the subsequent quarter and also for the remainder of the 2024 year. And speaking of that guidance, let's move on to that right now. On the earnings call with regards to guidance, Anthony Noto had prepared remarks discussing a mid-term guidance range going as far as 2026. One thing to note here about why 2026 is relevant is that we know management has performance stock units that are going to vest in 2026. So if SoFi basically hits their dedicated tranches of $25, $35 or $45 in 2026 and maintains that price for 90 days, then the management gets a big payday. So for the 2026 guidance, this is also very insightful. I mentioned this during the live stream when I was covering the earnings call live. It felt as though CEO Anthony Noto was directly addressing analysts such as myself, analysts such as Tanner and Chris, who go by these earnings reports line by line, trying to read between those lines and realize and translate what these remarks equate to from a shareholder value perspective and actually make sense of that. So let's first start with 2023 and 2024 guidance, and then we can move on to the sentiment around 2026. In terms of the full year 2024 guidance, the company expects to deliver a combined tech platform plus financial services of 50% or more growth relative to 2023 levels. They expect the lending segment to be slightly down from 2023 levels at 92% to 95% of 2023 levels. However, on the earnings call, they were asked about this, and they mentioned how extremely conservative their assumptions were to essentially be likely flat on a lending perspective. And one thing I will say, just to pause on this point for a second, is that this is just an initial look at their full year guidance. I don't think for a second that SoFi is going to close off 2024 with a negative growth rate on lending. I think maybe they're going to have a single digit growth rate on lending, or maybe even a 10% growth rate on lending, but it's not going to be negative. Because what do we know? SoFi raises guidance. In 2023, SoFi raised 3 individual times and they beat even the 4th time. And if you look at the variance between what they initially reported at the beginning of the year and what they reported at the end of the year, it's huge, right? It's almost double the numbers that they reported. So what does this mean? Simply put, it means that the lending segment could in fact grow in 2024 because a lot of the underpinnings were macro assumptions that SoFi made. And, Chris Lapointe talked about this on the earnings call. They highlighted their expectation was for unemployment to reach 5% and surpass 5%, which of course would be a super bearish stance on the economic outlook, right? It goes completely against the soft landing narrative. In reality, 2024 is an election year. The economy is more likely to head towards a softer landing. And as a result, these numbers may differ substantially from the guidance that SoFi provides towards the positive, right? And as we move down the list, the GAAP net income for 2024 for full year, SoFi expects to be between 95 to 105 million, which represents 7 cents to 8 cents EPS for the full year. Now, I think that they're going to come in much higher than this, but this 8-cent number is important. And the reason why is because Wall Street expectations for full year 2024 are between 5 cents and 6 cents EPS for the full year. Right off the bat, SoFi set the standard to say 8 cents EPS. This is higher than what Wall Street is expecting, and it still gives SoFi a little bit of wiggle room to raise this as they continue to execute. And in terms of adjusted EBITDA for the full year 2024, they guided 580 to 590 million, which represents a 35% year-over-year growth rate from the 432 million that they reported in 2023. Now, let's talk a little bit about the longer-term forecast. This is the fun stuff, right? Looking beyond 2024. Management highlights that beyond 2024, they expect 20 to 25% compound revenue growth for the time period between 2023 and 2026. Now, here's the caveat. This assumes no meaningful changes in the macroeconomic environment and no business launches or acquisitions. So just that right there should ring alarm bells in your head. First, on the macroeconomic side, we expect the economy to be in a better state than a 5% unemployment that they're assuming, right? In the next few years, we expect the economy to be steadily rebounding from 2022 and actually doing well. So immediately right there, the 5% unemployment is overly bearish for the economy given what we've seen. And second, no acquisition for the next 3 years? Come on. When have you seen SoFi not make an acquisition? SoFi's made 4 acquisitions in the last 3 years. They've made 4 acquisitions since 2020. Galileo, Technisys, Golden Pacific Bancorp, and Wyndham Capital. And you're thinking they're not going to make an acquisition in the next 3 years? That's number 2. Number 3, new products. Do you really think that this company is not going to significantly release new business lines over the next 3 years? Given how much they've executed, they even put up the first slide in their earnings presentation of all of the stuff that they've done in 2023. And you think this is the company that's really not going to release any new business lines in the next 3 years? And still, even taking all of this stuff out of their assumptions, they're still expected to grow 20 to 25% of compound revenue growth over that 3-year period. So right off the bat, this, like every other forecast that they make, is under-promising, okay? It's a lowball estimate. It's something that they can easily knock out of the park. Management continues, quote, "This implies 50% compound growth for financial services revenue, mid-20% compound growth for technology platform revenue, and mid-teens compound growth for lending segment revenue. This is expected to drive between 55 cents and 80 cents in GAAP earnings per share in 2026. Now listen to this part, this is important. Moreover, we see 20 to 25% EPS growth beyond 2026, reflecting both the continued growth of the core business plus the added benefit of new business lines launched in 2024 to 2026 time period. New business lines launched in 2024 to 2026. Meanwhile, in the previous breath, they were saying this assumes no new business lines are going to be launched. So which one is it? Are they going to launch business lines or are they not going to launch business lines, right? Of course they're going to launch business lines. So this is really important, right? And I think Chris Hager summarized it really well in this tweet. And he basically said, I'll just read it out loud. In case anybody is wondering what SoFi product roadmap looks like, we've had the biggest hint yet. Anthony Noto basically told us what businesses are not going to be included in the guide, but might be coming in the next 3 years. Small merchant business checking and savings, SMB lending, broader asset management business, insurance, broader credit card portfolio, new technology verticals for the tech platform, new geographies. Anthony Noto on the earnings call said, hey, this is our estimate for 2026, and it's not taking into account all of these other things. But then when he's talking about EPS, he's saying that there is an added benefit of new business lines over 2024, this year, and 2026. In other words, yeah, of course they're going to release new business lines, right? And that was another instance where I thought that management was directly talking to us, analysts who go line by line, like myself, like Tanner, like Chris, and like others, in breaking down these earnings reports and reading between the lines. That's so important here. He can't flat out say we're going to launch this because, again, they're under-promising just so that they can turn around and over-deliver. And even looking at that 55 cents to 80 cents EPS for 2026, Let's take a look at that, right? Let's plug in today's closing price of $9.16 and let's divide that by the 55-cent EPS to 80-cent EPS range that they're forecasting. That gives us a forward price to earnings range for SoFi for 2026 of 11 to 16, which is ridiculously cheap for the company considering this growth rate, even though they don't have any new business lines. And even though we know that they sandbag and they raise expectations 4 quarters out of 4 quarters, right? And so if you look at this company, it's a no-brainer that they're going to increase their growth rate. It's a no-brainer that they're executing fantastically, right? Like we looked at the segments are growing by double digits and triple digits, and meanwhile the expenses are growing by single digits or even falling in some cases, right? Anthony Noto continues in his remark, quote, "Make no mistake, the long-term opportunity for SoFi remains unchanged and we continue to believe that we're just getting started. There are endless opportunities for investment and growth, and we remain focused on the right types of durable growth for this stage of our company and within the environment in which we operate." Why would the CEO say 20% to 25% without any major acquisition or new product, and then right in the next paragraph say there are endless opportunities for us for investment and growth? That's literally acquisition, right? It's a clear sign that they're, again, under-promising so that they can massively over-deliver in any market environment. Even in the earnings call, in response to a question from Dan Dolev asking for more clarification on this 2026 profitability outlook, the CEO, Anthony Noto, highlighted that margins could even be much higher than 30%, but they're currently sticking to 30% as a long-term target because they essentially want to be disciplined in what they invest in while balancing growth and profitability. In other words, this opens the door for them to report higher margin numbers than 30%, but they're not flat out promising that to analysts today. High level is that while the products and the members came in lower than I was initially expecting for Q4, the management team delivered a 10 out of 10 earnings result, doubling down on their promise of profitability, keeping that promise, guiding for 2024, and the cherry on top of it all was these 2026 remarks, which allow analysts now to have a forecast out to 2026 and do that forward EPS calculation that we very quickly did to realize how cheap this business is relative to their growth prospects. And by all remarks, these were record results, especially on a yearly basis, especially when we look at those margins expanding with all 3 major business segments now being sustainably profitable and quickly growing. In terms of the market sentiment, I would imagine that it's very, very difficult today for bears to continue making arguments against SoFi as a company because profitability is officially announced, locked in, forecasted going forward. However, many bears are still going to make that same attempt. One of them is our favorite David Cavarini, who just hours after SoFi reported their stellar 10 out of 10 earnings report, he reiterated a $3 price target, saying that the forecast was more aspirational than achievable. And, that frankly just made me laugh because of how desperate that makes bearish arguments sound. And quite frankly, the arguments will increasingly fall on deaf ears as the company continues to execute. And a 21% upwards move in the stock price today further validates this sentiment. I'm personally excited to see what the company will report through 2024, along with new product launches, which I guarantee you they're going to have, along with new acquisitions over the next 2 years, which I guarantee you they're going to have. They just launched a new product even today, which I'm going to talk about in my Friday video, in my recap. So definitely subscribe to the channel to get access to that. But, at a high level, I want to take a moment on a serious note to congratulate the entire team at SoFi for this brilliant execution of what I believe to be a 10 out of 10 earnings report, and more importantly, that guidance for 2026. Very important. Nobody's really looking at it, and that is a distinguishing factor that's going to set SoFi apart for them to consistently surprise this market, because all of these analysts, I heard all of their questions on the earnings call, and I swear they were so tone deaf to the sentiments that Anthony Noto was putting out there. He was literally begging analysts to read between the lines of what this company can achieve, and none of these analysts seem to be picking it up. But luckily, I'm picking it up. I'm sure Tanner and Chris and others are picking it up as well. And we're going to be talking about that on the SoFi Weekly Podcast on Friday. For right now, I've been recording for over 40 minutes. This is the Fundamentals of Investing Podcast. Thank you so much for listening. And congratulations to all the SoFi bulls out there. I'll see you in the next one.